My name is Peter Moura. I'm the news editor at the East African. My team has been investigating a story on the bonds market in Kenya, and for the last 3 months they have been looking at data and speaking to people about how trading has been over the last 1 year. I'm joined by Emmanuel Were and Peterson Biongo, who have been looking at this data and who have done this story, and they are going to be briefing us on what they have found out from the story. So maybe to Emmanuel Were, tell us what have you found out and what you have for the readers.
Okay, the interesting bit about all this is early on this year there was a report that was just questioning some of the profits the banks were making, and especially it was questioning their bond trading, how the banks did not account for their losses in 2011 when interest rates shot up. So we just picked on this, and then we decided just to look deeper into the bonds market. How do investment bank trade the bonds market? How do banks trade some of these bonds, and what was happening in the bonds market then? Was it true what some of these reports were talking about? So we just started to look at the data from the market, and also we were speaking to different players within the market. Yeah.
And how did this come? Maybe Peterson, you can explain to us about the interest rates and what they have to do with the bonds market.
So basically what you would expect is, when interest rates go up, the value of the bonds goes down. They have an inverse relationship. But from what we observed, at some point there was a mismatch. You'd expect, at some point we expected, when interest rates started going up, bonds to follow suit.
Yeah.
But that was not happening. So at that point, we decided to go big on it and just analyze from 2010. And what we saw in 2010 was that what we expected to happen was actually happening in 2010.
Because when the interest rates were falling, right, in 2010, then the bond prices were rising. So banks, if you actually look at most of the profit and loss, you could actually see banks were booking very good profits then. But you see in 2011 what happened, I think the focus in 2011 was a lot on the shilling, but people forgot that when interest rates really shot up, some banks were caught out and their bond prices were supposed to have
maybe how important is the bond market? Maybe you can give us figures as to how big is the bond market.
Wow, the bond market has really been growing.
And how many investors take part in it?
Basically, the growth of the bond market can actually be looked at the turnover, because in 2009 the turnover was about 382 billion, around there. But in 2010, 2011 it has gone to about 900 billion. And this year some of the players are actually estimating that the bond market can actually cross the 1 trillion. And that's a psychological mark. If it crosses that, the players, obviously they'll be earning commissions. But you see, the bond market is important because the government of Kenya is which comes and actually borrows a lot from the domestic bonds market. Yeah.
So maybe Peterson, from the analysis that you guys did, what can you say about banks and how they made money from the bonds market?
Basically what was happening was, if you take the case of 2011, when interest rates shot up, banks did not expect it. I would say that banks were caught flat-footed. So they had a lot of banks a lot of bonds held in what I would call the basket of held for dealing. And what happens in such a case is that when interest rates shoot up, the valuation of those bonds, because they have an inverse relationship, interest rates go up, the valuation of the bond comes down. And normally what happens is that those losses, because of the valuation, are supposed to be passed through the profit and loss account. So to avoid this, some of the banks decided to move the bonds from that basket, now the held for trading basket, to the held to maturity. And so what we saw was a lot of bond activity, a spike in bond activity.
Okay, maybe let's go deeper into the story.
But also, just going deeper into that, the interesting bit has always been that if you look and speak to banks and other players in the brokerage industry, they always defend that that movement of one portfolio to another portfolio, which is actually okay, there was a lot of sell buybacks which are being transacted. These sell buybacks are where a bank has a bond, it can give another bank the bond, then the other bank will give it the money. But then in future, when this bank repays the loan, it gets its bond back. That's what's called a sell buyback transaction. And there are many of these happening. And the reason is in 2011, so many bankers have been saying that the interest rates, the cost of borrowing was really high. But then there was a loophole. Some of these sell buyback transactions were actually being used to move bonds from one portfolio to the other portfolio.
Are you saying in financial times, in financial talk, is it illegal to do that?
Well, it's not illegal per se, but the thing is how they were accounting for this movement. Because even when we did our story, we spoke to the different accountants, and we also spoke to analysts, and some analysts highlighted in a report that actually the sell buyback transaction, they should have booked a loss. Whenever you sell, you should have realized that loss. But you see, some of those losses are not being realized. There's one analyst who actually pointed out in that report.
So in that case, that brings me to the role of regulators.
Yes.
What are there regulations that the central bank has released, or which are there to try and regulate these things?
Well,
well, from what we saw, not really. And that has been a big question, because if you look at one of the players we talked to was telling us that, right now in August, at the end of August, is when the central bank are finished reviewing the books, the last year's account. So you can actually see the regulator is far behind the market. So at that point where you'd expect him to realize some of these transactions and take action, he's not able to do that because he's lagging behind the market. So not really.
But also the other interesting thing on the regulators, you find that it's sort of a silo. You have the CBK, you have the CMA, then the NSE is not a regulator, but it's the custodian of the data. And in these trades, that's where you can actually see what was actually happening. Then if you do ask for the counterparties, sometimes it's hard to get the counterparties. Like if Bank A sold to Bank B, the system should be able to track that. But getting that data has been one of the bottlenecks to it. Yes.
Okay, so maybe deeper into the story, what else did you find after the investigation?
Wow, I think the earnings, the bond traders, how much they earn, it's very interesting, and also their lifestyles, I guess. But I guess it was a matter of also the ethical part. Some questions were being raised. How do some of these bond traders actually earn quite a lot of money? I know there are assumptions being thrown up and about that some of them earn 3 million, but you can actually look from the data, from some of the data that we are analyzing. If you look at the commissions can actually come to about 3 million a month.
But from a business case, you see, they were being smart.
Yeah, from a business case, they were being smart.
They didn't do anything illegal. They just played the cards well.
They didn't do anything illegal, but there were questions about the ethics behind some of this, because in some of the cases, like some sources pointed out to us, that some of the traders can actually front run a client. By this I mean they know a client is looking to sell this bond, so they'd go back and speak to the client and tell them, I can get you a better rate, and they tell the trader in a bank, okay, we can give you a rebate, a kickback. And this is a really big issue in the industry, but not so many people really want to come out. Okay, it's sort of the elephant in the room. Not so many people want to come out and discuss this, because even the CMA, when we questioned the CMA and asked the CMA threw us back now to the investment banks, saying they are the ones in charge of their traders. They should be guiding their traders.
Okay. Maybe Peterson, a parting shot.
In terms of the investigation?
Yeah, in terms of the investigation and the board market. And
I would say the investigation has been very interesting, some very interesting insights. And I would say that the main challenge for us, like Emmanuel highlighted, has always been has been the case, how do we get data, accessing data. But overall it has been very educating, very thrilling. And yeah, we can just promise our readers at the East African more of this.
It will be just looking how and what the regulators do after maybe after our story runs, what happens in terms of some of these investment banks, and even will there be sort of a push now to develop the bond market, especially it has also been highlighted in international media about the lack of transparency. If there's better transparency in the industry, then we'd probably see a lot more activity in the bonds market. And just if you think about it, actually the government started issuing infrastructure bonds. It has helped us maybe build some of the roads that you're seeing, some of the infrastructure. If we get more active in the bonds market and we remove that opaqueness, I think that's a very good avenue for people to look.
Okay. Maybe from this exposition, you can see what has been happening in the bond market, how traders have been doing in terms of making a kill from the trading. But whether this is right or wrong, that remains, the jury is out, and maybe you can read more in the East African to see what is happening.